Hey guys, today we're going to be talking about this article that I was reading earlier today titled UN Agency Warns of Recession Linked to Imprudent Monetary Policy and how this affects the cryptocurrency market and the global economy as a whole. Because in order to understand what's going on with Bitcoin today and the speculation that's going on with the price of it going up, you have to look at all of these factors. A lot of investors out there are looking at things like this that we're going to be going over today and saying, okay, now is a good time to buy. They're speculating that the value of Bitcoin is going to go up short term if something like this was to go through. So let's talk about this article and why it's so important first. Then we're going to talk about some other things that I really want to put into focus in order to understand the whole bigger picture. So the UN is basically asking the Federal Reserve and other of these large banks around the world, these central banks, to stop raising interest rates. And the reason that they're doing that is because they noticed that there has been this dynamic shift between what we initially were doing at the start of the pandemic with quantitative easing all the way into what we're doing now, raising interest rates while inflation is still rising. So what it's doing is it's creating this extraordinary shift in the market in such a short period of time, and the market is actually being shocked by this. So the UN has basically said, okay, hey, pump the brakes a little bit here. Let's let the market chill out for a little bit, see what happens from there. Otherwise, we believe that it's going to be such an enormous shock that we're going to go into a full-blown recession. Now, some people out there might make the argument that we're already in a recession, but that's neither here nor there. Let's talk about quantitative easing real quick. So quantitative easing on Investopedia says it's a form of monetary policy in which a central bank, like the US Federal Reserve, purchases securities from the open market to reduce interest rates and increase the money supply. That's important. We'll talk about that here in a second. Quantitative easing creates new bank reserves, providing banks with more liquidity and encouraging lending and investment. In the United States, the Federal Reserve implements quantitative easing policies. Okay, why is this important? And why were they doing this initially at the start of the pandemic? They were doing this to encourage people to go out there and get loans. They were encouraging banks to lend more. They were saying, hey, we want to keep the markets open and fresh, and we want the money supply to continue flowing. So they did this as a way to spur the economy and say, hey, we're looking out for everybody's best interest, but it actually had the opposite effect in a long-term manner. When you look at what they did, printing all of this money, lending it out, and saying, hey, here's free money, all they did was create this inflation bubble that we now have because that money came from nowhere. It wasn't the gross domestic product in the United States going up. It was literally just printing money out of thin air and saying, hey, here you go. Here's a $1,400 check. Go out and spend it on your mortgage. But that's not what people did. People went out and spent it on whatever. They went and bought new TVs. They went and bought stocks. And the stock market was propped up by the Federal Reserve as well. In this quantitative easing, we had the Federal Reserve going out and buying stocks and bonds itself to prop up the value of the market. So it was this huge storm of what appeared to be economic growth, but it was all fake. None of it was real. Here's another article on Bloomberg that is hid behind a paywall, but I wanted to share the title and the start of this article. It's titled "The Unstoppable Dollar is Wreaking Havoc Everywhere But America." And what this article, I believe, is talking about is how we are raising interest rates right now, which is cutting back on the money supply because less people are going out and spending money. And so we've got less money on the market. And that's creating a problem for other countries that use the US dollar. Because there's less of it out there, they aren't able to get more of it. And that is causing their government, their economy to be strained. To give you guys a brief example of what I was talking about with the GDP, I want to look at a historical chart here that shows the GDP in the United States. As you can see here, we're actually in a negative GDP. What that means is that we're spending more than we're making now here in the United States. And that is a terrible thing to see. Usually, whenever you have a sustained negative GDP, that definitely shows signs of being in a recession or a depression. And we're starting to see the signs of that here. So I wanted to show you guys that just to have a little bit of a preface of what else we're going to be talking about. Take a look at this chart as well, United States existing home sales. As you can see here, we've talked a little bit about this on my channel. Sales of homes are plummeting. As the interest rates go up, less people go out and borrow money to purchase homes. And so we don't have new homeowners, we don't have new renters. All of these things are affected by interest rates, which are set by the Federal Reserve. As you can see here in the late 70s, home sales were going up. And then in the early 80s, the Federal Reserve created a monetary policy that just completely obliterated interest rates. They shot through the roof, and home sales obviously plummeted. And you can see that here on this chart. Okay. Here's a chart of the actual interest rates, and as you can see why home sales have dropped off dramatically here, it's because look at how high and how fast those interest rates shot up right there in the middle of this year. But if you look back at the 1980s, late 70s, you might see this and say, well, look at that. The interest rates were way higher. Sure. But you have to look at all things, and that's what I want to talk about today. The CPI, the Consumer Price Index, was not nearly as high back in the 80s. Also, your average wages, your average income was much higher on average per capita than it is today. The toll of inflation has caused wages to really stagnate and even go down over the years. And so you might take a look at this chart and say, well, interest rates were way higher back then, but you have to think about how much money people were making and what inflation was at in those times and say, okay, we have to look at all of the data and determine that with inflation where it's at today, with the consumer price index, having to go out and purchase things at the grocery store, having to pay for energy with as high as it is today, people are actually paying more for those things, and they don't have as much money to put towards a home loan or starting a business. As interest rates rise, that's another thing that you have to think about. Business loans, small business loans, people aren't starting businesses, and without small businesses starting, the economy crumbles. And that's exactly what we're starting to see. So what I want to get back to is the UN asking the Federal Reserve and other central banks to go back to lowering interest rates or at least keeping them where they're at. I foresee two things happening if interest rates drop or stay the same. If interest rates drop, then all we're doing is kicking the can down the road. We're not actually solving the problem here. We're not being any more fiscally responsible, but the long-term effects are still going to be there. So in the market, we might see things go up in value again. People might start investing again, and it might look like sunshines and rainbows immediately due to this cause and effect. But long term, we're still going to have all of the same problems that we currently have. We're still going to have a GDP that is in the negative. We're still going to have all of this extra money that was put onto the table that should never have been there. So in order to really fix the problem, we have to be more fiscally responsible and we have to raise these interest rates. Long term, it will play a much bigger role in the economy than right now. But if we continue to raise interest rates, then we're definitely going to feel a global recession like the UN is talking about, and they're terrified of that happening because so many people are focused on the here and now. They're not worried about what's to come, and that in itself is irresponsible. So going back to the two things that I was saying, one, if interest rates go down, we could see short term the price of crypto and stocks go up because people are getting excited. There's free money back on the table, lots more to play with. Or two, interest rates continue to rise. The Federal Reserve says, no, we're not going to go with what this plan is that the UN has drafted. We are going to continue to raise interest rates and we are going to fix the problem long term. Short term, it could be a very rocky road for assets like crypto and like stocks, but long term, it will play a huge role in making sure that our economy can withstand things like this if they ever are to happen again. There's also arguments being made out there that a crumbling stock market could create profitable opportunities for Bitcoin traders. Articles like this are explaining that Bitcoin could be used as a hedge against inflation. If inflation continues to rise, then the US dollar will fall, and people are going to be looking for other assets out there to use as a hedge against the US dollar, and they believe that Bitcoin might be one of those things. In fact, that's what Satoshi Nakamoto initially intended to happen for Bitcoin. So could that play out? Yes, it absolutely could. Do I foresee that happening? I don't know. It's really still yet to be determined at this point. This is the first time Bitcoin has ever actually been stressed by the market. When Bitcoin originated, we were finally starting to come out of the 2008 housing market collapse, and the market started going up over time. And for the past 10 years, 13 years, the market has just continued to go up until we had this pandemic. Ultimately, I think that either way, this is good for Bitcoin and the cryptocurrency market as a whole. But whether you're a short-term trader or a long-term holder is going to determine what type of strategy you should take as a trader. With that being said, please understand that this is not financial advice and I am not a financial advisor. Take all of these trades at your own risk. Look, if you enjoyed today's video and you'd like to see more videos like this, then please do me a favor and hit that subscribe button and turn notifications on. It really helps my channel grow and I would really appreciate it. That's going to be it for this video though. Crypto Clay, out.